So you need access to cash, and you're considering taking a home equity line of credit. This is often the easiest and quickest way to get your hands on money, but there are some risks you should be aware of. Today, we're going to do a deep dive on home equity lines of credit, or a HELOC. Hi, I'm Olivia Kirk.
I'm Tim Urich. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
For the best advice on controlling your cash flow, be sure to subscribe to our channel. And don't forget to hit that bell to be notified when we upload new videos twice every single week. So you need access to cash, and you're considering taking out a home equity line of credit because let's face it, it's quick, it's easy, and there aren't a ton of fees like with a cash out refinance. However, you need to watch our latest YouTube video. We go over the risks associated with a home equity line of credit that you need to learn before you take out that line. I would argue that most of life's frustrations come from not having access to cash when you really want or need it. When it comes to getting your hands on cash, a lot of times if you have equity in your home, it's easy to draw on a home equity line of credit.
But keep in mind, these types of loans are not without risk.
The main risk to think about, especially now, is interest rate risk. I was speaking with a client earlier this week. They took out a home equity line of credit just a few years ago, and the interest rate was 2%, and now it's over 9%. That is a huge difference in interest rate costs that they weren't accounting for when they took that line of credit out.
And another risk that most people never consider is the fact that you're not in control of that process. Home equity lines of credit can be called at the discretion of the bank. Make no mistake about it, the bank is in control. If for some reason they decide that you're not worthy of paying back somewhere down the road, they're going to stop the process and call the loan.
What does it mean to call the loan? What impact would that have on someone?
Well, here's a great example of not being in control when the bank calls the loan. Back during the 2008-2009 financial crisis, banks were calling in credit lines because they didn't want that exposure. And consequently, people who had outstanding lines of credit either had the lines closed or the loan termed out, meaning that the bank turned it into a term loan and gave them a monthly payment, which was a lot more than what they were paying previously, which may have been interest only. That's the danger of not being in control of the financing function in your life.
Leave us a comment down below. Did you have a home equity line of credit open in 2008 and 2009? And were you impacted by the bank calling your loan or terming your loan out? Now, if you had a traditional mortgage, maybe you decided to do a cash out refinance of your mortgage versus the home equity line of credit. With the cash out refinance, the bank owns the interest rate risk, meaning they can't change the loan interest rate throughout the term of the loan, and you're set for that 30 years with no additional risks. And that's the big contrast between a home equity line of credit and a conventional mortgage.
And let's talk about being in control. When interest rates rise and you have a fixed mortgage, the bank is stuck with that low interest rate payment that you locked into when you took out the loan. Now, if interest rates go lower, you could always refinance. So that puts you in control of the process rather than the bank. Now, make no mistake about it, you're still dealing with the bank, but now you're dealing from a position of control rather than from a position of being controlled.
Because let's face it, whoever controls your cash flow controls your life. If you'd like to learn more about how to regain control of your finances, be sure to check out these two videos. We picked them out special for you.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.